Hey, Bowtie Nation, Joseph Hogue with your weekly stock market update coming to you at Sunday at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, everyone thinks the housing market is broken, and they are not wrong. Prices falling, affordability gone, but the housing crisis has become an opportunity in five stocks I've found that are going to fix that problem. The last time I looked into the housing market recommending five stocks 2 years ago, those stocks jumped 92% within a few months. I'll reveal those five new stocks along with the catalysts that could come as early as this week. Stick around, and I'm also going to be updating my entire portfolio. Why shares of Supermicrocomputer were up more than 9% Friday, if it's time to sell after a 142% run in AMD and a 115% return on Symbotic, and why you need to hold on to those cybersecurity stocks. But first, on to those five stocks to buy in housing, because the housing market has been less than great in 2026. Not only have home prices fallen for the last 3 years, now down more than 7% from their 2022 peak, but mortgage rates are stuck above 6%, making affordability out of the question for new buyers. But crises always create opportunities, and in fact, the housing market has been an opportunity for years if you were looking closely. Like when I recommended six housing stocks on August 12th, 2024, buying shares of Zillow, Redfin, Open Door Technologies, Remax Compass, and Anywhere Real Estate on many of the same forces I'm going to show you today. Within just 3 months of that video, four of those stocks were up an average 52%. Anywhere Real Estate was bought by Compass for $1.6 billion, a 237% return for investors, and Rocket acquired Redfin for a 112% return. That is a 92% average return across those stocks, and I'm seeing the same kind of opportunity right now in a bill secretly making its way through Congress, one of the few pieces of legislation with support from both parties, and that could boost a very specific part of the housing market. To understand that opportunity, though, first you need to understand the problem. Lending restrictions after the 2008 crash and more than a decade of underbuilding have created a shortage of more than 6 million homes, according to AEI data. And you can see how this affects prices in some of the states with the biggest shortages. States like New York, short almost a million homes and a $420,000 median price. Florida, short half a million homes. And California, where the shortage of more than 2 million homes has pushed prices past $725,000 a home. Making matters worse, the jump in interest rates has driven buyers to a historic low. JP Morgan estimates there were 2.4 million buyers actively looking for a home before rates surged in 2022. That number of home buyers has been nearly cut in half to just 1.4 million. And while normally a jump in those trying to sell their homes from 1.5 million last year to over 2 million this year, that would normally mean falling prices. The massive shortage of housing meant prices aren't going down to clear that housing market. Recently, the government and big media have come down against the institutional buyers, companies like Invitation Homes and American Homes for Rent that have bought homes to rent out, saying they're the ones that are pushing out the buyers. But that's not the case if you look at the data. In fact, we need more buyers, not fewer. But the fact is, we're not going to be able to bring more buyers into the market until either home prices fall or interest rates come down to make those homes more affordable. And for that, enter the Road to Housing Act, currently making its way through Congress. The bill includes more than 40 provisions to increase supply and ease affordability through financing, permitting, zoning, and construction. The House passed its version in February, with the Senate passing its version by an overwhelming majority of 89 to 10 in March. It's about the only question with bipartisan support in Washington, and the bill is now advanced back to the House for consideration of those Senate changes that could get a quick vote when the Congress returns from break this week. And while a lot of attention will be on the build to rent portion of the market and those institutional buyers, which, by the way, I'm going to show you two stocks trading at 30% plus discounts next, but that undiscovered winner in the Road Act is the manufactured homes market. The bill would allow manufactured homes to be assembled without a permanent chassis, support an increase in federal loan limits, and relax zoning regulations for mobile home parks, changes that have been limiting this industry for more than 50 years and could represent a sea change in the business. According to Bill Bohr, CEO of one of the industry's largest companies, it could unlock innovation and dramatically increase the supply of lower cost, high quality homes. And that brings us to the first of 5 stocks to buy before that Road Act passes, with Champion Homes, ticker SKY. And looking at the price chart on these, the news has not been baked into these stocks yet. SKY is down from its massive jump in February after the House passed its version of the Road Act bill and could jump again when that bill becomes law. Champion Homes is one of the nation's largest in that factory built home market, with 46 manufacturing locations selling over 25,000 homes last year for $2.4 billion in revenue. Revenue is expected up just 6% this year and 3% next, both of which will be significantly underestimated if that Road Act removes those restrictions on the market. I'm also watching Cavco Industries, ticker CVCO, in this theme, with the same pop in February on that movement in legislation, but now back down to flat for the last year. The company is only slightly smaller than Champion at a $4 billion market cap and $2.2 billion in revenue across 33 manufacturing sites. Cavco has been aggressively expanding ahead of this Road Act, adding 2 new facilities as well as an acquisition that increased capacity by almost 60%. This company is more vertically integrated than Champion, with an in-house insurance group, Standard Casualty, and its own lender, Country Place Mortgage. These could help Cavco ramp up sales in a boom and give the company a little more safety across different revenue drivers. That expansion in the integrated model is set to come through in sales growth, with analysts forecasting 12% revenue growth this year, twice the rate of Champion Homes, and for earnings to top out at $23.86 a share. Legacy Housing, ticker LEGH, is the penny stock potential of the group, with a market cap of just $498 million, and didn't really see the run-up in shares earlier this year. The company is the fourth largest producer of manufactured homes, with sales focused in the mid-states and southeastern regions of the country. Like most small companies, analyst research is pretty sparse here, with just 3 forecasts for revenue, but a solid 10% growth expected to $182 million in sales this year. And if that Road Act opens up this industry, it's here that you could start seeing the highest return. I'm going to show you 2 more stocks with double-digit upside on this theme next, but if you haven't yet, use the link in the description and get your free trial on Seeking Alpha Premium. I've used the site for research for more than a decade to check fundamentals on a company, sit in on the company's earnings report, along with getting the bull and bear case for a stock. Use the link or scan the QR code here and try Seeking Alpha Premium risk-free for 7 days. If you like it, that link is also going to get you a $30 coupon off your subscription, so check that out. While the undiscovered upside around that Road Act is in those 3 manufactured home stocks, there is a contrarian play here that could be worth just as much. Now, a lot of the news is going to center on the big institutional buyers of those single-family homes, companies like American Homes for Rent, ticker AMH, and Invitation Homes, ticker INVH. Now, it's a talking point that sounds sexy leading up to those November elections, but in reality, these big money buyers only have about 1% of the existing supply of housing, and looking back on that data, the problem isn't competition from too many buyers, it's from not enough buyers. But these stocks have sold off anyway, with AMH down 16% over the last year and Invitation Homes down 20% over that period, as investors worry that legislation is going to put them out of business. Even the harshest restrictions, though, wouldn't force these companies to sell, and the Road Act includes loopholes for them to keep buying houses that need renovations. Plus, both companies have already shifted to a build-to-rent model where they're actually helping to alleviate that supply shortage, building houses for their own rental portfolios. Nation, that fear around the 2 companies has opened up a massive mispricing in their assets that I pointed out in our March 29th market update. Shares of American Home for Rent are up over 7%, and Invitation Homes is up 5% in just the 2 weeks since that video, with a lot more upside to go. And the reasoning here is some very basic math. American Homes for Rent trades for a market cap, that's the total value of the shares of the company, at $12.2 billion against its 60,337 rental properties owned across the US. Now, that implies a market value of just $203,000 for each home, and the price is even lower on a $15.7 billion market cap for Invitation Homes on its 86,000 properties, or a value of just $182,000 each. Now, that is a sizable discount if you consider the median home price of $405,000 across the country. Even if those companies were forced to liquidate their portfolios of homes, it could mean a cash machine that would send shares up 40–50% to those median prices. Now, both of these companies have solid balance sheets and pay a dividend over 4% while you wait. It might take until after the elections, but When investors see these companies aren't getting legislated away and the value locked up in these shares, these will run higher. Now, instead of highlighting the stocks I'm watching this week, I wanted to update you on my portfolio, how I'm investing in the stocks I talk about here on the channel. I get asked a lot for updates on stocks I've recommended, sometimes the same stock every week, so I wanted to do a quick update on the biggest stocks. But, Nation, understand first, if I haven't talked about a stock, it's because my outlook hasn't changed. I'm still holding, and if nothing has changed, then I can only update a stock maybe once a quarter, or we wouldn't have time to talk about those new themes and ideas. Also, though, and this might sound self serving, but if you're going to buy a stock on a YouTuber's recommendation, folks, you need to be watching their videos. I can't count how many times people have asked for a stock update in the comments when I just updated the stock in the previous video, or sometimes even in that same video. Yes, I know some of these videos can get on the longer side, but if you want someone to just to list out a group of stocks to buy without any analysis, you're going to have to find it from another channel. Nation, I want you to understand why I'm buying these stocks, the research I put in, so you can make your own decision and not just buy them because you saw them on a video on YouTube. I want you to be a better investor. If spending 10 minutes watching stock analysis on a video at 2x speed a few times a week is too much work, honestly, folks, if you're not willing to put in the time, then just buy index ETFs and do not invest in individual stocks because you're going to lose money if you're not doing that research. Overall, here in my main trading account, where I buy the stocks I talk about on the channel, and this is separate from my retirement accounts and the ETF investments. But you can see it was all rainbows and unicorns to October of last year, at one point up almost 105% over the 2-year period, and outperforming both the S&P 500 and the Dow indexes by a huge margin. But I'm mostly in those growth stocks though, and with that, you've got to take the sell-offs in stride. With the portfolio still up 52% over the 2 years, it's still better than the 30% return on the S&P and the 23% on the Dow, but you need to be able to wait out these corrections. Looking first here at Super Microcomputer, ticker SMCI, up $97,000, up 9.5% on Friday there. But this is a roller coaster, folks. I've said it before. If you get scared out of your stocks, you do not need to be investing in this stock. You have to be patient because I do believe it will come back from these recent lows. And in fact, it's up over 25% just in the past few weeks since that big sell off. And one of the more important points I want to point out here is this covered call strategy. You can see in the shares, I'm down about $250,000 here. But down here with the covered call strategy, where I've been selling call options on this, I've collected over $89,000 in covered call options. And I've been using that strategy since we started buying, selling calls when the shares were around $45 to $55 range, and actually collected another $134,000 over the last 2 years. So my cost basis here is just over $20 per share. Nation, that is what you need to be doing on these roller coaster stocks, okay? Not waiting for the long term to push these stocks higher, not waiting for that valuation case that we'll talk about to come out. You need to be taking advantage of the volatility and using it for your benefit, selling covered calls against these to collect some of that money, take some of your risk off, and be able to stand out these or withstand these big downside drops. I'm going to continue to hold my shares and still believe SMCI is significantly undervalued. You can see here revenue estimates for 88% sales growth this year, the $41 billion. None of the fundamentals have changed over the last 2 weeks, folks. This company is still at the forefront of that AI server, AI infrastructure building race. What we saw on Friday was a lot of that AI stock theme coming back, that infrastructure race with deals by CoreWeave, with a lot of these AI infrastructure stocks coming back because investors are once again realizing that $700 billion is being spent this year alone building those data centers, buying the infrastructure, of which SMCI is going to get a big chunk of that. Another news we saw here just on Friday, just this week, Supermicro accelerating deployment times of data centers with its new Gold Series Enterprise server solutions. Okay, this is a big upgrade in server solutions. It's going to have over 25 different server systems based on Supermicro's proven product families. So what it's doing here, it is allowing that data center infrastructure build out to happen even faster. Okay, one of the big bottlenecks to AI and AI models and to delivering those models, that compute power, is just getting these data centers up. This server solution combined with SMCI's proven product quality in those servers, being able to handle those AI workloads is driving this stock, and it's going to drive it back higher. I know this has been a roller coaster stock, folks, and if you get scared out of your stocks at every little dip, do not buy this stock. Buy something else. This is a roller coaster. It's going to continue to have that, but it's significantly undervalued on that revenue growth, on that AI infrastructure build out. Do not panic sell, and you will make money here. Here, I'm also in shares of funds that hold in Ethereum. That's the ETHA, that's the iShares Ethereum Trust, as well as the ETH, that's the mini trust there. Have almost $1 million in those two stocks. And yes, Ethereum has come down, but folks, tokenization is still coming. We saw a 3x increase in tokenized assets last year, and you can see here there are very fundamental reasons why this is happening. Why assets like real estate, like money market accounts are being tokenized, put on the blockchain and handled because you've got that fractional ownership. That tokenization divides those assets into smaller fractional shares that can be bought by any investor. You've got reduced cost and efficiency. Tokenization automates this process, cutting out a lot of intermediaries and is lowering costs on everything in the financial world. 24/7 global trading. A lot of these tokenized stocks are traded in Europe. People that don't have access to the United States markets can trade Apple, Tesla, any of these stocks 24/7 around the world. You've also got enhanced transparency and security, as well as increased liquidity. All these reasons why we are seeing this wave of tokenization, why it's going to continue. We have seen a big dip in the price of Ethereum, down from that 4,900 record peak just last September and October. It's still up 43% over the last year, and the Ethereum network continues to hit new highs for network usage. And folks, this is the backbone of all of that tokenization. Now, you know I don't believe in price targets for cryptocurrencies because there's really just no way to price something that doesn't have fundamentals like revenue growth and like earnings per share. But again, this is the backbone to tokenization. All that increased usage, the increased assets coming on blockchain is going to go directly into Ethereum. Just back to that $4,900 Ethereum peak would be 122% on these funds. And we're going to get there in less than 2 years. Next, looking at shares of advanced micro devices, AMD here. Nobody believed it could compete with NVIDIA when I started talking about it last year. We're up 142%. And actually, I am starting to get a little antsy here, around $250 a share. The CEO, Lisa Su, is still promising 30% plus revenue growth. And we see here in analyst forecast, 34% expected this year, 43% revenue growth expected next year. And what's really been driving the stock is the increase in profitability, improving to 60% EPS growth this year from $4.17 all the way up to $6.67 expected for this year. That was the big overhang on the stock. Why wasn't it as profitable as companies like NVIDIA? Why wasn't it able to turn this massive sales growth into earnings growth? It's turned that around, and that's what's driven this 142% return in the shares. But we are getting a little stretched on valuation here compared to where we started buying at last year. It's now at 10.2 times sales, so a price of 10 times the revenue expected and 83 times earnings. That's not terribly expensive compared to like NVIDIA, which is actually trading at around 15 to 20 times sales. So it is still cheaper than NVIDIA, but way more expensive than we started buying, right around 6 or 5 times price to sales last year. So for this, I might consider selling some call options on the January expiration date just to kind of hedge that risk, take some of that risk off the table and lock in some of that gain. Here, if I really wanted to take risk off, I would sell the $250 call options. That would get you almost $50 for each share of your stock, right? That pretty much locks in that $250 strike there. You get $50. That is a huge downside protection, folks. You're protected basically all the way down to $200 per share, and you get we'll say at 20%, you get a 20% cash return or cash payment on this, selling those call options. Now, I don't want to completely sell out of my shares or of the upside potential. So I would probably go to this $300 strike price. Okay, that gives you upside further to $300 per share, but you still collect almost $32 per share on your stocks here. That's going to give you that cushion down to about $210 per share, but it is still going to give you that upside up to the $300 per share by January. Shares of Symbotic, ticker SYM, have come down from their $83 peak, but it's still up 115% return on when we started. Now, investors have started to worry that that growth is slowing and lack of really big news. We can go here to the news releases and see that the company does continue to sign on partners and promote more automation projects for warehouse and logistics. But that lack of really big news and some of the slower growth is kind of taking this stock down from its highs of $80 a share late last year. But folks, that partnership with Walmart on its robotics and warehouse automation is locked in, and that tie-up with SoftBank takes this one internationally, revolutionizing the logistics market. We are still looking at 20% plus growth this year and next in sales, up to past $3.5 billion next year. But really, it's the earnings here that are taking a hit on that big spending. So I do want to see management put on some smart growth and maybe focus a little bit more on profitability. I'm willing to give them a little bit longer because that strong advantage in logistics space and the huge growth theme that this represents. Looking at our cybersecurity stocks here, these continue to get slammed on the fears that AI is going to take over the revenue growth in this sector. We see here CrowdStrike Holdings, ticker CRWD, down 18%. Palo Alto Networks, largest company in the space there, down just 1%, so holding up a little bit better. Fortinet, ticker FTNT, down 10%. Zscaler's the one been getting slammed hardest, down 30% from when I started buying it. And you can see it's really been this year that those fears really started accelerating. This week it was with Anthropic's Mythos model. But the irony here is, folks, Anthropic isn't releasing that Mythos model because they say it could help hackers infiltrate companies. So actually causing higher cybersecurity threats and adding to the demand for these companies. In fact, CrowdStrike and Palo Alto initially jumped on this news that Anthropic is partnering with both of these companies to fix that potential threat. So actually getting more revenue and being first in line to really address these new threats from hackers from some of these AI models. Like some of these stocks selling off since last October, it is hard seeing those stocks fall so fast. Now, the 5 stocks I own here are down an average 22% this year, and Zscaler down 47%. But nation, if you do your research here, you're going to see that a lot of that AI software threat, this is another big opportunity. AI models are still hallucinating. They're still being used by hackers to get in. Companies are not going to just flip a switch and let their most critical supply or the critical network security up to an AI agent. Okay, that just isn't going to happen over the next 2 or 3 years till these models are tested and trialed. Okay, that is going to mean a lot of the sell-off in these stocks just recently over this last year is going to become an opportunity because we're going to see those revenues continue to go higher. Investors are going to come back into these shares and bid them up from these crazy low valuations. Also looking at SoundHound here, ticker SOUN. It doesn't report until early May, but it's going to be closely watched in that with the shares down 64% last October. It's still above the $4 share price we started buying at 2024, but you can see here it has taken some losses. Now, I took some profit and sold some of this in January when some of those covered call options exercised. So again, taking advantage of those big spikes in the price, selling some of those covered calls, taking some of that money off the table, but then bought in again in late February around this $8.90 share price. So I am down about 27% on this new batch of shares that I bought. The stock has been hit on multiple factors here, but is still a great company and a great bet on that agentic AI. Now, revenue growth is slowing from just doubling sales every year, but it is still very strong at 37% expected this year, though investors are worried here because it's still posting those negative earnings. Okay, so expected to post negative 5 cents per share in earnings this year. Shares are also down on just that general rotation out of AI stocks and the crash in software names since October. This stock now in show me mode, up from the $4 when we started buying a couple of years ago, up past $20 per share, now back down under $7 each, but has some serious competitive advantages in those those AI assistants, and it continues to sign partnerships to prove its product. This stock is back in value territory at about 12 times this year's sales and still could be that moonshot investment in AI. Look for the link below and try Seeking Alpha Premium risk-free for 7 days and get $30 off your subscription. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.